Welcome back. If you're buying a home or refinancing, choosing between a 15-year and 30-year mortgage can be overwhelming. This decision impacts how much you pay monthly, your total interest, your equity growth, and ultimately your financial freedom. Today, we're unpacking the real numbers, industry data, and strategic insights to help you pick the mortgage that fits your goals perfectly. Why does this matter? Because the average American carries mortgage debt of about $207,000 as of 2024, according to the Federal Reserve, making mortgage terms a huge financial factor for millions. Your choice affects your net worth, monthly cash flow, and even stress levels. Let's jump into section 1. What's the difference between a 15-year and 30-year mortgage? The 15-year and 30-year mortgages are two of the most common fixed mortgage rate terms. The main difference is obvious. The repayment period. A 15-year mortgage requires you to pay off your home loan in 15 years, while a 30-year mortgage gives you double the time. 30 years to pay off the same amount? This difference affects your monthly payments, interest rates, total interest paid, and equity growth. Interest rates on 15-year mortgages are generally lower because lenders assume you pose less risk when the loan is repaid faster. According to Freddie Mac's primary mortgage market survey, as of Q1 of 2025, the average interest rate on a 15-year fixed mortgage hovered near 5.5%, while 30-year fixed mortgages average about 6.4%. This is a roughly 1% difference. This roughly 1% difference might look small, has an enormous impact when compounded over decades. The difference in monthly payments is striking. For example, borrowing $300,000 for 15 years at 5.5% will require a principal and interest payment around $2,600 a month. In contrast, a 30-year loan at 6.5% will cost $2,000 monthly for the same loan amount. While that's $615 monthly savings on a 30-year mortgage, you might weigh that against the extra interest paid over time and longer debt horizon. With a 15-year mortgage, your monthly payment applies more quickly toward the principal, meaning you build equity faster. Equity is the part of your home value that's yours truly. It grows as you pay down the loan balance and as the property appreciates. Faster equity buildup can be critical for refinancing or selling decisions and provides a safety net. Section 2. The total cost of borrowing. How much do you really pay? The total interest cost over the life of your loan is the biggest factor distinguishing 15-year and 30-year mortgages. Let's examine the numbers. On a $300,000 loan at 30-year mortgage at 6.5% interest results in total interest payments around $400,000, more than the original loan itself. Meanwhile, a 15-year mortgage at 5.5% carries a total interest cost near $140,000. Less than one half of the 30-year loan. This $260,000 difference isn't just the statistics, it's real money that could otherwise be invested, saved, or used to build wealth. According to the U.S. Bureau of Economic Analysis, Americans' average saving rate fluctuates around 5 to 7%. Redirecting that $260,000 from interest to investments with a 7% average annual return could compound to nearly $500,000 over 30 years. Keep in mind, a higher interest rate on a 30-year loan is partly a risk premium lenders charge because longer loans increase uncertainty, life events, job changes, or economic downturns can increase default risk. Shorter loans reduce this risk, reflected in lower rates and total interest paid. Section 3. Monthly payment affordability and budget considerations. The most obvious disadvantage of a 15-year mortgage is the higher monthly payment, which can stretch budgets thin. Financial experts, including Dave Ramsey, recommend your total housing payment, including principal, interest, taxes, insurance, and HOA fees, stay below 25% of your monthly take-home pay. This guideline helps avoid becoming house poor, owning a home but struggling with everyday expenses. On the flip side, the lower monthly payment of a 30-year mortgage often allows buyers to qualify for a larger loan amount. While tempting, this can lead to purchasing a home beyond realistic means, increasing financial strain and long-term risk of default. Studies by the Urban Institute show that mortgage delinquency rates rise significantly when monthly payments exceed 30% of income. Putting a larger down payment can offset monthly payment burdens. Putting down 20 or even more reduces the loan size. decreases monthly payments, and eliminates costly private mortgage insurance from 10 to For instance, increasing your down payment from 10 to 20% on a $400,000 home saves about $150,000 in the long run. Also, consider other financial priorities like retirement savings, emergency funds, and lifestyle expenses. Sacrificing too much to afford a 15-year mortgage can create pressure, especially if income fluctuates. A well-planned budget that includes a buffer for unexpected expenses is critical. Section 4, flexibility, life changes, and financial planning. Life is unpredictable. That's why flexibility in mortgage payments can be valuable. While a 15-year mortgage offers speedier payoff, its higher fixed payments may be less forgiving if you face job loss, illness, or other emergencies. In contrast, the 30-year mortgages' lower payments provide a financial cushion. Homeowners can sometimes skip or reduce extra payments in lean months without risking default, making it easier to manage cash flow. However, it's worth noting that most mortgages allow prepayment of principal without penalty. So if you can afford it, making extra payments on a 30-year mortgage effectively mimics a 15-year loan, combining flexibility with cost savings. Unfortunately, data shows most borrowers do not consistently make extra payments due to competing expenses or lifestyle choices. Long-term financial planning means considering inflation and investment opportunities. Mortgage investments are fixed, so inflation reduces their real costs over time. Meanwhile, funds saved by choosing a 30-year mortgage could be invested elsewhere, potentially outpacing mortgage interest rates, but this requires discipline and sound investing. Section 5. Making the best choice for you. There is no one-size-fits-all answer. Your decision depends on your income stability, risk tolerance, life plans, and financial goals. Are you seeking the fastest route to debt freedom, or do you prefer lower monthly obligations to invest or save elsewhere? If paying off your home fast and reducing total interest paid is your priority, a 15-year mortgage clearly wins. Homeowners with the 15-year loans typically gain financial independence years earlier and avoid paying hundreds of thousands of dollars of extra in interest. If cash flow flexibility is critical for you, for example, if you have irregular income or want to prioritize other investments like retirement accounts, a 30-year mortgage may be more appropriate. The lower monthly payment can free up resources to build diversified wealth. Your credit score and loan qualifications also matter. 15-year loans can have stricter requirements due to higher monthly payments. Conversely, a 30-year loan can increase eligibility long-term, but might limit your buying power long-term. Ultimately, consult a trusted mortgage professional or financial advisor. They provide personalized projections and help model different scenarios based on your unique financial profile, helping you make the most informed and strategic mortgage decisions. Well, thanks for watching. Thanks for watching this deep dive into 15-year versus 30-year mortgages. If you learned anything valuable, hit that like button and subscribe and share with someone facing this important decision. Drop your questions or experiences in the comments. I'd love to hear what path you choose and why. Until next time.